This is episode 12 of Trading Bot Sessions, where we talk with traders who have built automated trading strategies and trade everything from stocks and options to futures and crypto. In this session, I speak with Adam Grimes, Chief Investment Strategist at Talon Advisors, who has well over 2 decades of experience as a trader, analyst, and system developer. Adam and I discuss his early start in futures, the wisdom he's picked up over a nearly 30-year trading career, how to develop a successful trading strategy, psychology and how that plays a role in your edge, and ideas from his book, The Art and Science of Technical Analysis. This is Mike Christensen, co-founder of Traders Post, and I trust you'll enjoy this episode of Trading Bot Sessions with Adam Grimes. Well, Adam, thanks very much for joining me here on the show today. I've been really excited to chat with you for some time. I actually first heard an interview with you on Chat with Traders some years back.
Oh, that's cool.
With Aaron Fifield. So
Yeah.
I'm happy to have you on my show here today.
Great to be with you.
Yeah, absolutely. Maybe we could kick this off with just a little bit about your backstory and career and really how you got into trading.
So I almost said my path wasn't a traditional path, but what is a traditional path into trading, right? Everybody finds there's such a range here. But my formal education, I was a musician. In my pre-college days, I was kind of a strange child in many, many ways. I was equally drawn to science and also to music. And I decided of those two passions to pursue music professionally. Got a music degree, was working as a musician, and shortly after I graduated from college, I got this. This was back in the days when the scams used to come in your mailbox rather than email. So I got this flyer from this guy in a cowboy hat. And some people will know who I'm talking about. I think he's currently on the run out of the U.S. from, I don't know. There's this whole story. But he had this, the system, which ironically, you could do worse. He was looking to buy what he called 1, 2, 3 bottoms. So looking to, buy a higher low. And then where the plan kind of fell apart was his idea was you could open, say, a $1,000 account and basically corner the entire cattle market if you caught the right kind of trends. You just keep pyramiding in. And while it's theoretically possible, of course, there's all kinds of reasons that won't work. But something about that, I don't know why. I took a shot at his approach. I opened an account. I had no clue what I was doing. I had less than no clue what I was doing. My first trades, it was I don't remember exactly how big it was. It was no money. It was less than $5,000. And each trade was $100 round turn with a full service broker. So your probability of being successful is somewhere hovering right around zero. I pretty quickly blew out that account and blew out several more accounts. But in the process, this was something clicked. I was like, this is really cool. I had never, I knew enough about my psychology to know that I wasn't really drawn to gambling. I'd been to casinos and, playing the lottery really did nothing for me because I always knew that I could, looking back, what I realized was I had this intuitive sense that the odds were stacked against me. So I just didn't really want to play the game. But there was something about trading that was really intriguing. And I went through this process of educating myself, and I was fortunate early on. I made some contact with some people who kind of became mentors. I didn't ask the right questions. I asked very stupid questions, but I asked them to the right people who answered those with a good deal of patience.
Which in fairness might be the right questions after all, right?
Perhaps so, but they were clearly questions that said this person doesn't have the first clue about anything. And I eventually figured some things out, and the first significant money I made was day trading British pound futures, not cash, the futures. And this was back in the late 90s. I had my data feed was on a dial-up modem. I was on another phone line. It was the kind of situation where eventually my orders were actually going to the floor. So, this is an experience which really is not available anymore. But when the market was kind of crazy, the British pound was crazy in the late 90s, as some of you know. And I would many times be placing orders before I got fills back. So I'd have to kind of keep track of my position. It was pretty crazy. And in retrospect, I think I got lucky. I like to say, I think I'm one of the unluckiest traders ever in that anytime I switched to something new whether it's a new approach or a new time frame, a new asset class, invariably I lose money. It is 100% guaranteed. You can short whenever I'm doing something new. You can just short that for a while, even if there's a pretty successful period of forward testing before the moment I push the button to go live. So I kind of joke about that, and I know, but in retrospect, I think being unlucky is actually being very lucky, because you don't get that false degree of security. And I was lucky enough to have the reinforcement of making a little bit of money and realizing maybe I don't completely suck at this. Maybe there's a possibility. And over the years, I then transitioned to trading the S&P futures intraday. And again, guess what? That was a giant speed bump for more than a year. I bled for more than a year, and that was around 2000. And I did that for a while. Once I figured it out, I got an MBA and combined that, which people ask how relevant that is to trading, and I would say really not very. What I got from that was that I get a lot of emails from people asking, like, what kind of education should I have? And I think a business school education, what you're really going to have to do is unlearn a lot of what you learned, because you're going to learn a certain way of thinking about the market, thinking about financial markets in general strategically. You're going to learn some very useful things, but when it comes to you sitting in front of the screen pushing the button, you kind of got to forget it all, because it really doesn't apply. I did do a good deal of quantitative work in my MBA, which was a little bit unusual. I went to school where they basically let me swap out a big chunk of the MBA coursework, PhD level coursework, which I was, probably not really equipped to do, but I learned a lot. And up to that point, what I think was a little bit unusual about my approach, I've been primarily a discretionary trader. I've done a decent amount of algorithmic work and systematic work, but most of my trading has been discretionary. However, I've done a boatload of really pretty hardcore statistics behind that. Mm-hmm. And statistics both from I do a good deal of coding myself, so a lot of actual computer programming research, but also I think it's very important, at least for me, to do a lot of the work with pencil and paper. So I am just as likely to do a Python backtest and look at non-parametric stats from results, or to sit down with a stack of 200 paper charts and start going through those by hand. That really, I find, hones my pattern recognition. And over the years, to get to where I am now, I've traded really pretty much every liquid asset class a U.S. investor can trade. So, there are things available in other parts of the world that we really can't trade. Every time frame, I've done everything from 100 trades a day, which is insane. Please don't do that, to very long-term portfolio construction and a lot of intraday, or I'm sorry, a lot of swing trading to me is not really a time frame, but looking to hold for like a few days to a few weeks. Most of my trading over the past decade is concentrated on that. And about a year ago, I started relearning, re-educating myself in doing S&P day trading. And that's not been a super smooth transition. It's not quite where I want it to be yet, but it's also I like the challenge. It's also kind of fun to suffer a little bit, I guess, which is definitely what I'm doing. We can talk about a lot more, but I think that gives you enough insight into my trading, I think, maybe.
Sure. So a trading career spanning almost 30 years, a little over 30 years now?
Yeah.
And you said most recently you're looking at S&P trading. Are you trading the SPY ETF or the S&P futures?
The futures, and also swing trading, primarily U.S. listed futures, have been trading quite a bit individual stocks and options, but gravitating more to futures over the past few years.
And are you primarily long only futures, or are you long short?
Oh no, long short. And stocks too. Long short. I think you could make a compelling case if you were only trading U.S. listed stocks to only be long. There's definitely a case to be made there. because you can be really good on the short side and manage to break even. Like if you're trading individual names during a period when the market is advancing and you break even, that's a huge victory. So I think you could be long only. You'd have to have some mindset to know when the environment eventually changes and to get comfortable shorting. I think, though I traded a lot of individual names 2007, 2008, 2009, primarily on the long side there, even in that ripping bear market, you can trade to the long side there. I think futures, though, every now and then I run into people who, one of the other businesses over the past 10 years or so, I've advised a lot of institutional clients, a lot of hedge funds, a lot of money managers, a lot of advisors. And I have run into a significant body of traders who want to only be long energy futures. And that to me is a pretty hard sell. It was maybe defensible in 2009, 2010, when people were thinking we might go a different way with energy. But there's still a lot of people who are thinking in that direction, and they don't generally stay in business very long. So I think one of the advantages, I started out as a futures trader, and I think that's one of the advantages I have as a trader, is that being long short is equally comfortable to me. Yeah, well, I think one of the best trades we've seen in energy has been natural gas against the super bullish narrative driven by the war in Ukraine. Everybody knew that natural gas was just going to explode to crazy new highs, and the market was showing none of that. And I think that, I tend to really ignore narrative as much as possible, but it's really where it gets interesting to me is when there's something that's obvious that everybody knows, something that's very clear in the narrative, and the market's telling you something else. Those counter narrative trades can be very, very powerful. So even there, I know a lot of people who just could not bring themselves to short natural gas because, fill in the blank, and you could, in fact, fill a book with the reasons why shorting natural gas was stupid as it continues to decline. So
right,
I don't know.
From a technical perspective, nothing but downhill for a long time there. So
yeah.
Great short trade. So given that your approach in futures, then do you have any common approaches you're taking these days? Any common setups you can share?
Well, it's, I do write about these things, and it's not a secret. Like, I publish all this pretty clearly. I primarily trade consolidations and trends. So you might think flags or pullbacks or pauses. And I'm not too, I think in terms of what I would call functional analysis. So I want to understand what the range is doing. I care about that much more than what the pattern looks like. A lot of people will draw all of these distinctions between these different angles in the consolidation. And to me, it really doesn't matter that much, because at least the paradigm that I work within is that the market is pretty noisy. There's at least some component of more or less random action in the market, and the visual appearance of the pattern is not so important. So most of my trades are pauses or consolidations and trends, which have some overlaps with breakout trades, I guess. I will intraday look to do more fade trades, more trades against ranges, because, as you said before we started recording, today was kind of a choppy range day, and I think you do need some skill sets to trade those. But the problem is that the mindset, if you think about a ranging market and a trending market, the problem is what you need to do in those two environments is mirror image opposite. If you knew at the end of the day that the market was going to trend up all day, and of course you don't, but imagine if you knew, then it literally would not matter where and how you bought. You could do any stupid trade. You could just buy every down close. You could buy every up close. It wouldn't matter. You could buy every time a bar touches the low of the previous bar. And this,
close your eyes and click.
Yeah, just close your eyes and click. And if you knew the market was going to chop around, then you would use a very different set, which would basically be a set of rules, which would be something like, look at what the market has done recently and just go against that.
Mm-hmm.
So the way you manage those trades, the psychology, if you're in those big trending markets, it pays to be a little stubborn. And everybody's going to say, oh, never be stubborn with the market. But this is another thing that I rail and rant against all the time, these trading sayings that people have that just aren't true. They're true sometimes, but you can't tell somebody this thing, it's always true. Always the list of always true things in trading is very, very small. In fact, it might just be don't violate your risk management parameters. That might be the only one that's a never. But never add to a losing trade. Well, if you're trading in a range, you're going to be adding to a losing trade. It's one of the best ways to trade.
Mm-hmm.
The idea of get out when the trade doesn't look good. There's all these variations of that. If you're in a trending market, you should really give it the benefit of the doubt. And it's a very different, not only a very different set of technical tools, but a very different set of psychological tools. And this is why most traders don't do both of those kinds of trading equally well. Yeah, there's nothing wrong with that. You just have to know how you're wired, and then figure out how to kind of bend yourself to fit in the right kind of market environment so you don't hurt yourself.
Sure. So you mentioned earlier that you try to ignore the market narrative as much as possible. So I assume that as you're evaluating an entry from a technical perspective, what else do you gather, be it fundamental or technical information, to decide how you're going to maintain your position? You say that you want to maintain a little bit of that stubborn approach so you can maintain your position well inside of a range. How else do you bolster your confidence?
Nothing else that's relevant. In fact, my my job is usually compromising my confidence more than anything. I work very, very hard to once I put a trade on, my initial out of the box assumption is this trade is going to be a loser. And I, even for years, I constructed my P&L sheets so my P&L would diverge from my broker statements, because when I put a trade on, it would record it as a loss. So I would put the trade on and my account would be charged as if the stop were hit. So I assume the trade's going to be a loss from the beginning. And once I put a trade on, I switched to looking very actively for information that contradicts. And this is confusing for people in some cases, because one of the things that I do, I record for our MarketLife members, I record these daily video snippets of market analysis, and we've never deleted one. So, all of my opinions, right or wrong, are always on, they're always there for anybody to go back and see. And what I will do, I've been very bullish on stocks for many, many months here, even in the short term. But most of my commentary is looking at, and in most cases, rejecting bearish points. So I'm really focusing. I make myself focus on things that contradict my trade thesis. And what are these things? They're purely technical. There's absolutely no case. I would be happier not knowing what the news was. I would be happy not knowing that, Activision is in the news, because of, I do know what's going on, of course, but I really kind of wish I didn't. We do quite a boatload of fundamental analysis and fundamental modeling. And I use that that's very, very dangerous, because that work gives us currently a pretty convincing bearish bias over the intermediate to long term. So over several months to perhaps several years. But I have to be able to know that's there and to know that work is valid, and then completely ignore it, because on the time frame that matters to me, everything I see is bullish. So I have to be very comfortable. It's always degrees. It's always it's never completely bullish. And if I look at something and it's completely one-sided, then it's probably, it's like the old stories of you getting a taxi cab, and when the taxi driver asks you about the market, that move is probably over. Or when it shows up on cover of USA Today, or some other popular document, when everybody's talking about it, when there's consensus, the move is probably over. And if I don't see the contradictory information, I'm probably missing something, or I'm probably looking at a climactic move. Now, I have rules for trading those, and there have, over the course of a career, there've been some cases where it's almost a little ridiculous, because if you have decent technical skills, you have these markets that are kind of ripping in these parabolic moves, and all you're doing each day is just moving a stop to the correct place. So I've had positions that I can't get out of for weeks and weeks and weeks while they move in my favor. And at some point, it is absurd. You're like, I just want to be stopped out of this just so I can take it out of my mental space. And I just, what you're basically asking is, I want to stop making money. But those are the points where, what I'm acting on are my technical rules. It's not my opinion. I'm not in it because I'd rather be out of it. But my rules tell me I get out of it when this level is hit. And if not, I have nothing to do but just sit there and be forced to make money. It's a good problem to be in.
So most of this year we've been, I think many traders and investors have shared the opinion that this is sort of the most anticipated recession we've ever had. And yet the technical story of the market is a much different one. We seem to have had quite a bit of a rally. Has that technical sort of contrarian approach served you well this year?
Oh, absolutely. Yeah, I agree with the recession forecast. I think that, and we should be careful, because maybe a recession doesn't necessarily imply a market collapse. I personally kind of think that's in the cards too. I wouldn't be surprised to see it's the same thing you have in a healthy ecosystem. You need a forest fire periodically, and that's the way financial markets are. And unfortunately, that forest fire is going to be really painful to a lot of people. What I'm talking about is a situation where indexes trim 40 to 60% from highs. So, we're talking end of the world for some people. And then there could potentially be, one of the things I'm telling people a lot today is to go back and look at the stock market from the 1960s to the 1980s, and to look at it on a both on just a pure price basis, but also an inflation adjusted basis. And we do need to be careful, because we've seen a market that has, even knowing what happened in 2013, 15, 20, I would say this is essentially a market that's done nothing but gone straight up from 2009. And there are a lot of people today who have never lived in a market that does anything but go straight up. So we're going to see people get really hurt. We're going to see maybe cataclysmic moves through some industries. Retirement, significant wealth is going to be destroyed. I think that's going to happen. I don't know when that's going to happen, but I've been super aggressively long over the past few months, and continue to be. In some of our trading accounts, we're literally as long as we can get. We have been as long as we can get. And to me, I think one of the core skills of trading is being able to hold these dissonant ideas in your head, to say, here are two things that are almost completely opposite. Which one am I going to focus on? And the answer to me is clear, because it's clear to me based on time frame. And I also know that if when that turn comes, I'll miss the first part of it. That's also, I think that's one of the most destructive things in the developing trader's mindset, is this idea that I have to catch every little piece of it. And for me, I know I have to be comfortable missing the first part of that move. And if you go back and look at the history of where I got bullish over the past several quarters, I missed the first part of the move. I think I got the message pretty quickly in this case, to be honest. But when the time comes to shift to being bearish, I'll probably take a little bit of a hit to my long positions. And I'll be a little bit late on that. That's absolutely okay. It's the only real way to do that, because if you're not going to do that, then what you're going to commit to doing is shorting constantly into a market that's rising against you. And not only are you going to take a lot of losses on those, you're also going to miss out on the long side. And then, by the time you've been kicked in the teeth a dozen times shorting, you like to think you will, but you probably won't have the guts to go in for size once it's real. So people who execute those kinds of trades will, I don't think that's a way to make a lot of money consistently. Now, this says nothing. I guess I also should, anytime I rant against what essentially could be mean reversion trading, in my experience, mean reverting systems are some of the best systems to trade algorithmically. So this could be a different thing. You very well could be a trader who focuses on picking off the short-term overextended spots in a very systematic approach, and you might have been shorting with wild profitability over the last few months. But what I'm speaking to and against is the mindset that's so prevalent, particularly in social media and with developing traders, where they just end up on the wrong side of a market over and over.
Yep. And agreed there. I've had a lot more success with mean reversion than momentum. Yep. And a big part of that has also been improved by filtering against the regime that we're currently in. So really trying to buy bottoms during bull markets and sell tops during bear markets. That has been a successful filter.
Good.
So even as a discretionary trader, do you see any key components in developing a successful trading strategy from an algorithmic perspective? Do you have feedback or advice on that?
Again, I have done a good deal of system development, and my statistical testing to support my discretionary trading is basically algorithmic trading. I think the keys are the math you need is not complicated math. This is one of the mistakes people make. Many times you don't need anything more than the ability to average something, but you have to understand what you're doing on a very deep level. You have to. So I think the call is for a deep understanding of a fairly small set of tools. For instance, if you're averaging something, what can go wrong with that? When should we maybe look at a median instead of an average? What could be lying to us in the data set? Should we cut off outliers or not? In many cases, the answer to that, I think, is pretty clearly no, because many times our profits live in those outliers. It's understanding what you're doing with the tools. Be careful of complexity. People get, I like to say, multiple passes through the data. A good example of how to do that would be, let's say you come up with, I don't know, a candlestick pattern, and the test isn't so great, but then you combine it with another indicator, and you do maybe 20 optimizations, and you end up with a few that look good. And then you take those few that look good, and you add another indicator. And so, you go through this process, and what you've ended up doing, of course, is finding I think of it as you've made the question match the data. Your trading system is a question, and people say curve fitting, but that's not really accurate in most cases. What you're certainly over optimizing. You want to be careful about complexity, because most things that work are relatively simple, and most things that work that are complex are naturally complex from the aggregation of many simple pieces. If it's a different kind of complexity, where if you want to sit down and use, there are books out there you can find, like complex digital signal processing tools, or tools from physics that you apply to markets. Those probably in most cases aren't going to work very well. But if you have, say maybe 3 or 4 relatively simple systems working together, that can create a kind of complexity that can indeed be useful. Also, be careful of out of sample testing. I think this is something that people do very poorly. What most people don't realize is, so I would argue, at least I can't do any actual out of sample testing because I know the market data. The way that out of sample testing really should work is you have like this sealed envelope that has data you've never seen before. You do your system development, you open that envelope and you run it on that data. The trick with the out of sample data is you can only use it once. You can only touch it once. You get literally one shot at the out of sample data. If it's not good on the out of sample data, you can't, and this is what everybody does. They put it back in the envelope, they cut it off from the data set, they go back and they do more work on their system, and then they come back to the out of sample. It's no longer out of sample. I would argue it's probably not even really out of sample if you've lived through the data, if you know what's there. So forward testing, in most cases, is probably a better tool than actual out of sample. It's a much better tool than poorly done out of sample testing. But I think that's one of the places. It's not unusual to see somebody who says, "Oh, I think I'm doing out of sample," but what they're doing is, they're optimizing except for the last 2 years, and they'll create many systems and then keep testing on the last 2 years. That's not out of sample at all. One of the things that I really like to do when I'm thinking about any kind of optimization, and optimization is not a dirty word. We treat it like it's a dirty word sometimes, but the correct degree of optimization is learning. That's just what learning is. If you over optimize, of course, it's a bad thing. But one of the things that I like to look at with optimization is to look at a surface. And I like to see that there are a cluster of values that do well rather than like just this one random point that jumps up out of that.
Got it. Good feedback. So am I correct that you're currently working on a book around trading psychology?
You are semi-correct.
Okay.
I've been working on a book. So this book actually is finding its expression in a course, a training program, rather than a book, at least right now. I sat down to work on the book, and I had the book completely outlined, which is months of work to get to the point. And then when I started writing it, a couple of things pushed me back from it. Much of what I want to do with this is extremely interactive. So it's based on a little bit more interesting about my background that not everybody knows. You're going to be one of the first people to put this out to the public. I also have quite a bit of experience working as a hypnotist, and also decades of experience as a meditator. And I've been able to mash these two things together into a training program that, everybody says, for instance, one of the challenges of trading psychology is to understand your limiting beliefs. And there can be a boatload of those. We all trail various traumas from upbringing and early experiences. And, if you had a failed business, there are all of these things about success and money and other people that play into our psychology in ways that we probably don't fully appreciate. And so everybody says, find your limiting beliefs, understand your limiting beliefs, and change them. And if somebody is being more constructive, they might say the only way you change a limiting belief is to replace it with a constructive belief. Okay, there's certainly some validity to that, but what's that mean practically? When you actually start to roll up your sleeves and do the work, it becomes a difficult thing, because I like to think about things. This has served me well over the years as a trader. I like to think about things in the limit. I like to think about things sometimes to the utter absurdity. To imagine, for instance, what happens the morning we wake up and every single person in the world is bullish the S&P futures. What does that day look like? It's never going to happen, but it's interesting to think about that. Imagine that your limiting belief is, I cannot fly. How would you, which is, obviously probably a valuable belief for staying alive if you're up on the high buildings, but how would you go about replacing that with a belief that to your experience is completely untrue? Well, let me say that again. So how could you possibly replace that belief with the belief I can fly? So if you're a struggling trader who you look at your trading account and you have a string of losses, what good's it going to do for you to replace your belief I'm a struggling trader with I'm a winning trader? So first of all, that could be a very dangerous thing to just up and replace, because what do you do? All of a sudden you start like betting your whole bankroll on every trade, because what do you know? Like, you're a winning trader. So it's very difficult to know how to shape and massage these psychological issues. And I thought that the learnings that I had, and dare I say, some of the wisdom that I've dredged up from my own experience over the years, which came through a pile of mistakes. I don't mean to imply that there's anything like supernatural here. I learned by mistake. I think they are best taught in an interactive format. So I put the book on hold, and we have this training program that's piloted. It's being piloted to a very small internal group of people. It's not available to the general public. It probably will be at some point in the future, and the book will probably find its way out. But I have, I do think I have some observations here. I think there's a lot we do wrong with trading psychology. I would argue that, just to kind of give very rough outlines, the answer to a lot of psychological problems is doing the right thing, which seems very backwards, because you think like, I'm going to have these psychological revelations that then are going to let me do the right things trading. But many times the negative psychology you're perceiving is like, if you're having negative psychology because, any kinds of reactions, because you're not following your rules, you should not feel good about yourself. That's a case where you should be struggling with some negative psychology. If you are trading without an edge, if your system just doesn't work, there's absolutely no point in doing psychological work so you feel better about your trading. So I think people focus on psychology in the wrong way at the wrong time. I think psychology belongs in support of an edge. Now, there are plenty of traders who have an edge and just can't execute for various reasons. And for those people, psychology might be absolutely the most important thing. But I think there are a lot of lies and misconceptions that are sold to the trading public under this umbrella of trading psychology.
Yeah, agreed there. And your analogy earlier about limiting beliefs, I think, is an important one, but you also made this reference to what I would describe as more of your identity about yourself as well. The idea of being a losing trader versus a winning trader. And I think that plays a massive role. The narrative you have in your mind about your own abilities, I think, plays a role in the decision making you're making on the fly. Would you agree there?
Absolutely. This work that we're doing, this training program that we're piloting, actually begins with a very substantial set of questions that forces people to face their motivations, personality traits. And the people who are working through this, their initial reaction is that, wow, this is really challenging. It's really hard to look at myself like this and ask these kinds of questions. But we go through our lives, we don't have time in every moment to ask these profound questions. You couldn't function as a human being if you were constantly tripping all over yourself, asking these questions of serious depth and significance. But I also think that and I know your focus is highly systematic, but I think even systematic traders, there's this idea that psychology isn't important. I just need to know how to execute, like when to push the button. But the reality is, I know nobody who's been successful in the long term without doing, one way or another, serious psychological work on themselves. Now, it does not have to necessarily be, everybody's different. It doesn't have to be meditation. It doesn't have to be going to therapy. Both of those things are great. I've done both of them for myself as a trader. I would strongly suggest that most people who want to trade size, want to trade significantly, seeing a professional for some mental help is an absolutely fantastic use of time and money. And you're going to learn things about yourself that are absolutely going to affect your trading. This And, as you can probably tell, I've struggled down this path myself for so long that I think I'm pretty well equipped, at least to show people where the problems are. And so I'm pleased that the reaction coming back from people is these questions are really hard to ask, but that's, that's the real work. It is hard.
Yeah. And I think it's maybe not overlooked, but an entirely fundamental and extremely important facet to cover as a trader, whether you're discretionary or systematic. I would argue that one of the variables that gets overlooked in terms of back tests and a systematic approach is your involvement in the process. Not
Right.
only your biases, but also your interventions. If you get in the way of the system or stop it prematurely, you're never going to realize its complete upside or its potential. So I think psychology plays a role for everybody, regardless of your approach to markets.
Yeah. And, if you're a systematic trader, there's also a point where you do need to pull the plug on the box. And how do you know where that is?
Sure.
There's also the question of, like in this set of questions, we're having people really look at what resources do you have? How much time do you have to be a trader? Because this is definitely going to affect how you're going to do it. Like, if you're a slightly insane person like I am, and you're going to dedicate your life to this, then yes, you can do things like, teach yourself math, teach yourself coding. You can learn, and you can build these entire data management systems from ground up. If you don't have that kind of time or the inclination, then you need to find a more out of the box solution. How much money do you need to make? And, it's not uncommon to find somebody who says, I need to make $100,000 a year and I have a $10,000 trading account. Well, you can maybe do that this year, but more likely going to lose your account. People taking a very serious look at the support network they have around themselves. Too many people kind of struggle against their family, or they haven't brought their family into coherence with their trading. So I do think there are a lot of things, and as far as I'm aware, these are issues that nobody has addressed in trading psychology in any kind of systematic way. And we'll see. As I said, these are hard questions. We'll see what happens when a group of people get forced to stare into the abyss for a long time. We'll see what happens.
Are there any key lessons from the book behind you there, the art and science of technical analysis, that you think are relevant as well?
I'm currently going through, I don't know if you saw on social media, I'm doing, as I said, I'm a slightly insane person. So I'm doing these very large scale live interactive sessions. Have you seen the Hudson Sessions?
Oh, yeah.
There are 12 chapters in the book, and I'm doing 12 of these. We've had some requests for a live session, so maybe we'll have some kind of meet in New York for one of the last sessions or something. But I'm spending between 3 and 4 hours in these presentations, going into each chapter in exquisite and sometimes painful detail. And also looking at, this book was 10 years ago, looking at what's changed in my thinking, which really isn't very much, but of course there have been some evolutions. I think the big lessons to the book are, first of all, the importance of actually having an edge. So we just spent 15 minutes talking about psychology, and I would emphasize and re-emphasize that trading psychology is only valuable in support of an actual edge. Now, it's possible you might not be able to find an edge without having proper psychology. So there's definitely some circularity to this. That's one of the other lessons here, is that very little of this, and even in systematic development, it's not a linear process. It's not like you complete step A and then you go to step B and you go to step C. Ideally, that would be the case, but a lot of times it's like you do step A and you do step B, and that teaches you something about step A. So, you're kind of learning through this more like a web of development than through a linear flow chart. And the other thing that I think many people find very challenging is the idea that there's a significant component of randomness and uncertainty in the market. Luck will play a part in your results, and it might be hard to untangle how much luck is responsible for your results. And the degree of variability in markets is something that I think most people struggle to accept and to really wrap their heads around. I think though maybe you were expecting a lesson like use this moving average or buy this pattern, but the framework is much more important and to me. And then there are a lot of ways that we can operationalize this, if we can make that a verb, into specifics. So we can distill this down into specifics if you have the right framework and the right mindset.
No, I appreciate you covering that. And I would agree. I think obviously positive expectancy is priority number one, or having an edge. It's also an area that I think can contain a lot of misconceptions. So, how would you define whether or not you have an edge?
Well, I'd want to have a reasonably large sample size, and that people say, well, what's the magic number? There's no magic number. It depends. For some reason, the number 30 is floating around in a lot of the popular discussions about trading stats. You have to have at least 30 trades. I think I know where that misconception comes from, but I'd say you probably have to have a lot more. It depends on the time frame. It depends on the style of trading, but you'd probably want to see a reasonable positive expectancy above transaction costs. That includes bid ask over a pretty large set of trades. We could compromise depending on, I do one of the things that I kind of famously and strangely do is some testing on some really old, bizarre data sets like commodity prices from the Middle Ages. And as you can imagine, data integrity is a bit of a question. It's not very clean data, but the core of the approach that I use, I think would have worked through the entire history of the entire history of financial markets that we know, at least. But you also could convince me that, particularly if it was a short-term system, an intraday system, that you might not need to go back very many years to prove that you have an edge there. I don't necessarily need to see that something you're day trading today would have worked in 2002 necessarily. In fact, it very likely might not. So all of these questions do include some aspect of art, but you want to see some kind of reasonable stability. And one of the things that I think is critical is to monitor your performance on an ongoing basis, so you can be sensitive to that point when the edge might degrade and when something might shift there, because that does happen over time. Markets change.
Sure. I think there's an aspect to developing a system, particularly if it's intraday, in which you're going to also want to take market regime into account, because that market regime can change and be supportive to your approach, but then of course eventually change again, and then the edge is lost, right? Did you have thoughts around how you might detect market regimes? I've seen mathematical approaches, I've seen technical approaches. What are your thoughts around how you detect where you're at?
Well, the problem is that any test of anything is really a joint test of your specification and whatever might actually be in the market. That's something that is missed, but we know intuitively that's true, because we know that one person can look at a market and say it's an uptrend, another in a downtrend, and it depends on how you're looking at it. So for me, the best way to quantify a regime, and I do think this has been, I have a bunch of statistical tools that I use and look at, and I think, frankly, they've lost a lot of power over the past 2 decades. I think the predictability of the regime for a particular trading day is much less dependent on what came before. For instance, used to be that if you had a pretty wide-ranging trend day, today would tend to be more of a consolidating, mean reverting day. And I don't see that is convincingly true in a more recent data set. So I'm coming to the conclusion that enough people have done this relatively simple math that some of these edges might have eroded. I'm not certain, and one of the challenging questions I've asked people is how clearly how much value is there in even defining trend state? let alone market regime. So there is obviously there's a huge balance. I'm not communicating this very well. It's been a long day, between being responsive in the short term and sticky in the long term to the regime. And that's relatively easy for me to quantify on the daily chart. So you're looking at the regime lasting months to quarters, maybe even years. It's much harder to come into a trading day and to say this is likely to be a ranging day or a trending day. It is, however, not so difficult once you're in that day to say this is what's happening. And what I think, if you're an intraday trader, what you have to be able to avoid is the situation where it's happened to everybody. If it hasn't happened to you, you haven't been trading long enough. But those days where it was just a beautiful uptrending day and you lost money because you were shorting into it all day. And the reason you were shorting into it all day is because you were misreading the market environment consistently. You thought it was a ranging environment, and you were seeing things in the market that made you think that. So one of the tools that's very useful for an intraday trader is, I don't have it right here on my desk, but to get a little voice recorder that you can trigger either audio or just by pushing a button. And anytime you make a trade, this is a form of journaling. Record a little, like 15 to 30 second snapshot of what you were seeing. If you're a discretionary trader, what's making you make that trade? If you're a systematic trader, hopefully this isn't useful. You have a different set of things to evaluate. And what you then can do, if you look at what you were seeing that led you to be on the wrong side of the market, there was some point where you should have just known that you were on the wrong side of the market. And you can kind of refine that sense and know where that was. That's kind of the big mistake in regime identification. It happens. I think the only way I know for a discretionary trader to really learn this is to just get punched in the face a few times. But if you're getting punched in the face and you're not identifying what you did wrong to allow that to happen, it's just waste. It's just waste. You just lost money for no reason. But I think that's one thing that kind of evaluation is very useful, because many times what traders will tend to do from a day like that, it was a painful day, so you don't want to look at it. And you'll say, well, I'm not going to do that again. Well, that's the goal. You don't want to do that again. But it's a very unnatural thing to look at your decision process at each point and see, how was I misfiring? What was I missing? And I think the best way to be able to coach yourself like that is by having those little snippets of audio.
So do you have anything you're working on next that you'd love to share?
Well, so that training program, which I think will probably find its way out to the public sometime later this year, I hate to say I'm optimistic, but I'm very optimistic. We'll see what happens when this first group of gladiators go through it. And, we'll see how people suffer with it. But I think this has the potential to be transformative in a way that I don't know any. I mean, I'm pretty familiar with what's out there in terms of trading education and psychology. And anytime somebody says, I've done something new, you need to be a little suspicious. Have you really? How many things are really, truly new? But I think this is really new. And I think this has the potential to move the needle for a lot of people. I'm also really excited about the Hudson Sessions, which are, people can find that on my Twitter at Adam H. Grimes, my Twitter. I tweet all of those. They're completely free. They're live and interactive, and I know we do them in the middle of the afternoon, New York time. It's not always convenient around the globe. I know how that works, but people can submit questions in advance. It's a good opportunity for people to get questions answered, and it's the spending several hours on these topics. I think when these are done, this will be a valuable resource for the trading community too, because we're going pretty deep and pretty weird on some of it. I just did one this weekend where I spent a lot of time on this assertion that price movements are sometimes random, or even mostly random sometimes. That's something that people push back against for various reasons. And there are some good reasons, but we started with a look at how the ancient Greeks thought about randomness and some of the mistakes that were made through history and thinking about randomness, and then connecting to the Italians and the late Renaissance thinking about gambling and their work on randomness. So it's a pretty nerdy deep dive into a lot of these trading related topics, and it's good for me. I'll tell you, I started doing this as a project for myself, and then I thought I should really just do this with the world, share this with the world, and we'll see if people have an appetite for 12 3 or 4 hour sessions. But it's kind of cool to be able to do that and put it out there for free too. So I know it's going to be a resource for a lot of people.
Okay, great. Well, I'll make sure to provide a link to the Hudson Sessions. Aside from your Twitter as well, Adam H. Grimes at Twitter, do you have any other locations people can go to get a hold of you?
Yeah, so my MarketLife.com is my subscription service where I do daily market analysis, U.S. stocks, U.S. futures, options. There's some interactive sessions there and some coursework there that I'm pretty proud of too. We have some pretty finely crafted and honed courses. Also my blog, adamhgrimes.com. There are hundreds of thousands of words in blog posts going back to back over 10 years now. Also, you can Google me. Like if you want to see what I've written about moving averages, you can just type moving averages and then Adam Grimes, and that will, Google's done a great job, of course, indexing my blog. That'll pull up a lot of things. But I think that those two resources, I try to use Twitter, and we'll see what happens with Twitter now that the world seems to maybe be shifting there a little bit.
Threads, but maybe,
maybe I don't know. I kind of use Twitter as a central place. I tweet everything I do there, so people can use that as a hub. But also my blog's a great free resource too. And I try to put a lot of stuff out too, because I know particularly developing traders are overwhelmed with paying for things, and everybody wants a dime, and I'm torn between when I make a course, I spend hundreds of hours of it. I do a lot of work, and it's a huge creative task, and so that's something that I and the people who work for me have to be compensated for. But I also try to put out a boatload of free material too, and just to I think that because I know there was a time when I struggled to pay for education too, and so I try to kind of put some good out there like that too.
I and I'm sure I speak on behalf of everyone who's listening, appreciate that, and look forward to any continued work you have for us.
Thank you.
Well, appreciate it. This has been an invaluable conversation. Can't wait to get this published, and appreciate your time, Adam. I hope we can do this again soon.
I've enjoyed it. Let's do it again.
All right. Take care.
Take care.